Assalamu alaikum. Good afternoon, everyone, and welcome to NBO's interactive session. I think I'll decline those. Sorry. Today we will be discussing the half-year financial results for the period ended 30th of June, 2026. Before we begin, I would like to remind everyone to keep their microphones muted throughout the presentation. We will open the floor for questions during the Q&A session. It is now my pleasure to introduce our esteemed management. We have Mr. Abdullah Al-Hinai, our Chief Executive Officer, Mr. Giridar Biritijari, our Chief Financial Officer, along with members from the finance team. Mr. Abdullah, the floor is yours.
Thank you very much. Assalamu alaikum wa rahmatullahi wa barakatuh. My name is Abdullah Al-Hinai. I'm the Chief Executive Officer of National Bank of Oman. Thank you very much for taking time and meeting us virtually. We're going to present mainly our financial performance for the first half of 2026. I'll start with some basic slides that we always present in such forums, and then we'd be happy to take any of your questions, be it in English or in Arabic. Slide 4. A lot of the attendees who have met us or saw us would have seen this slide, but I'll not dwell on every aspect, but I'll select key elements of this slide. National Bank of Oman is the first locally incorporated bank set up in 1973. After a successful 5-year strategy that started in January of 2021, we've concluded the 5-year strategy in December of 2025. This is the first half of the first year performance of our new 3-year strategy. Our 3-year strategy, which I have a separate slide on, is basically to leverage and build up on the success of our 5-year strategy. The performance of the first half clearly indicates that we are on the right trajectory, inshallah. Another key aspect that's Oman is the strong shareholder base. We continue to have similar as in the past. Commercial Bank of Qatar continues to own approximately 5%. The late Sheikh Suhail Bahwan owns around the 15%, and then the rest are distributed amongst different shareholders. Over the past many years, we've been focusing on technology and being efficient through digital offering. This we request Misha. Misha, you can just Thank you. We've been investing in technology, and we continue to do so. We believe that our offering through the technology space is market leading. Strong financial metrics, and we're going to talk about that in more details in the next few slides. Slide 6 and 7. Again, I'll not take you through each and every aspect of this, but I think most people would be interested in terms of how did the overall economy fared under the regional situation. Alhamdulillah, Oman has been blessed with both the political and fiscal policies that it has adopted over decades and decades to help navigate the current situation. We strongly believe that Oman is well positioned to weather the storm and rather leverage and build on the opportunities that might arise. Overall, the market has been very positive. The liquidity situation continues to be ample and strong. The opportunities continues to be building, while we actually see visibility and stronger visibility in terms of new opportunities that have been emerging for local banks to participate and build a business case. From a banking sector perspective, that's slide number 7. Again, a very strong growth. Unfortunately, we did not have the full information for the second quarter. So a lot of this information is regarding the first quarter for the banking sector. But I have some key details of Q2 as well, or H1. The banking sector grew by about 13.8% in terms of loans and advances, and saw a very similar growth in customer deposits by 13.6%. This clearly indicates that there's a balanced growth between loans and the liabilities, the asset side and the liability side. And the loans are funded predominantly through customer deposit. Most of the bank have all the banks have posted very strong performance in the mid-teens levels, again demonstrating a very strong and robust performance by the banking sector. Definitely, like I mentioned about the macroeconomic picture, the banking sector is well managed through a robust and supportive regulatory environment, which has been set up by the Central Bank of Oman. And we continue to benefit from those positive regulatory environments. The sustainability piece continues to be also a focus area for the country and for the banking sector. The government had announced a commitment of net zero by 2050. There are a number of initiatives that the government has announced and continues to announce to lead the country towards a net zero emission by the 2050. It's also part of Oman vision. Multiple pillars of that vision directly links with the overall sustainability of and development aspect. Ministry of Finance continues also to support such initiatives, and the Central Bank had come up with a number of circulars since 2024 to promote sustainable and green financial practices, in addition to other aspects such as financial inclusions. Slide 9. This is in particular the slide about our new 3-year strategy that started in January of 2026. We call it PRIME for short. P is for profitable and sustainable growth. This is a very important aspect for us. People who have witnessed our performance since January of 2021 would have seen that we are clearly focused on profitable growth, a very disciplined approach in terms of that, and ensuring that any steps that we take forward has to be a sustainable step. We continue to do that, and it's well emphasized in our 3-year strategy. How do we achieve this? Through strengthening our customer relationship. Being the oldest locally incorporated bank, we do carry a long history of relationship with different segments of the market, be it government, be it the corporate and individual. We continue to build on those and build and strengthen, deepen a relationship with our customer base. Innovation and technology are key aspects which covers the I and E of PRIME. We are accelerating our digital transformation. We are shifting and diverting a lot of our businesses away from the traditional distribution channels to more digital and technology-based channels. And this is a key focus for management in the next 3 years. The requirements of the market that we operate in, and specifically our customer base, has been changing and emerging. The technologies that we operate with has also been changing and becoming more complex, thus ensuring that the organization does have a future-ready workforce is very key. And we continuously looking at upskilling our talent, bringing in the right skill sets that are required for today's and tomorrow's requirements and demands. I've talked also about the technology piece, and we don't shy away from partnering. We are happy to partner. We've created a number of different ecosystems that has been well accepted by the market. We are the first bank to actually create an open API environment through the Central Bank of Oman's regulatory framework of Sandbox. We've also launched a number of initiatives and collaborative services. On Commercial Bank of Oman in particular, I've repeated this, that we are the first Omani commercial bank. So we carry quite a bit of important history and legacy, and we continue to make sure that every step that we take is actually one leveraging on that history, but ensuring that it is continuously defended and we build on it. Today, National Bank of Oman has predominantly in Oman, but we do have a small operation in UAE, in particular Dubai and Abu Dhabi. The Egyptian operation has completely ceased. We're in the final stages of exit formalities with the authorities in Egypt. Slide 13. This is my last slide, and then I will request Giri to take us through the financial. Just key aspect of our performance in the first half of 2026. Net profit grew by close to 15% to around 39 million Omani Riyal compared to first half of 2025. Both our loan book as well as our deposit book has grown in a very similar fashion, about 9%. So again, clearly demonstrating ample liquidity in the market and our keenness to ensure that our funding is customer-based or customer-driven funding sources. One of the things that we are very proud about is on the net interest income side. We've been able to improve that matrix by about 12%, growing to close to 60 million Omani Riyal in the first half. Our capital adequacy continues to be quite robust. A lot of people who have been tracking us are aware that we've successfully concluded a transaction in Q4 of 2025. We carried two of these capital instruments for a while, and we repaid the maturing or the at the first call for one of the 81s in the early part of Q2 of 2026. Our capital impairments, although it has increased, it looks like at an increase of 38%. But again, it's just our prudency. We continue to carry slightly additional provisions from Q1. We continuously assess the situation on a continuous basis, and we take the right steps whenever it is required. Alhamdulillah, in the last 5 years, there were no new names that were added to our stressed accounts. everything continues to be moving in the right direction, and we continuously building up ECL to ensure that we have enough margin and cushion there. With that, I will end my slides and request Giri to take us through the detailed financials.
Thank you, Abu Hisham. Assalamu alaikum and good afternoon to all of you. Good to see a number of familiar faces and names on the call. Before I jump into slide number 14, I will reiterate the message that we have been to community for the last 5 years. We have a clearly defined strategy. We execute on the strategy, aim to have no surprises. We aim to have a well-capitalized and liquid bank, meaning balance sheet being very strong, and that enables us to choose what we want to participate, what credits we want to participate in, and drive the business in a profitable manner. So this slide 14 talks about some of the metrics that the CEO talked about just now, which included the net interest income growing year on year. Clearly, in the market, cost of funds have been an issue. We are very disciplined in terms of what we pay for deposits. We have set out in the past how we manage liquidity in the bank through meeting with the businesses and the funding sources more than once a week. That's number one. The second thing I would talk about here in this slide on the left side is the cost to income ratio. We do invest in 3 areas, which are people, technology, and the brand. We continue to do that on a regular basis. Bijoy, I see a question. Allow me to complete these few slides and we will take your question for sure. So you see that the cost income ratio has been steadily improving. We see for the first half of this year, ending the year at a cost income ratio of just around 39%. We have mentioned that we don't see this number going down further too much because of the need to continuously invest, not only in people and technology, but also regulatory changes which are happening around us. Then on the return matrices, really ROA, up 7 basis points, ROE, slightly down that because of what the CEO just talked about in terms of carrying 2 AT1s there was an overlap between the period of raising the AT1 in November and repaying it on the first call date of 1st of April 2026. Then you see the net impairment ratio. Again, we told you that we will manage the bank to the approved strategy and execute on the approved strategy, and taking the prudent level of provisioning that is required. That broadly sums up the operating performance. I'll pause, maybe 3 slides, and then I'll pause. Asset quality, again, some of the aspects that I touched about earlier. We are very conservative in terms of how we approach lending. The CEO mentioned that there were no new credit defaults or NPAs actually is the right word, during the last 5 years. That continues. Predominantly, we said we were growing in the JRE segment, but then that comes up with the challenge of the pricing, right? But we managed that well. Book grew 7.1% this year, and year-on-year basis, 9.3%. We have a very diversified portfolio. Clearly, we are building the provisions. The NPA total provision as a percentage of loans is 4.2%. NPL ratio 4.4%. We said, if you remember us in the past, just hovering around the 5% mark. And then the stage 2 loans as well, in terms of number coming down, nothing major to flag out. New loans, growth of loans causes that. You can see in the tables below, in terms of the coverage ratio, moving up from 91.7% in June 2025 to 97.1% in the first half of this year. Overall, good performance here in terms of the provisions and the growth of the loans as well. Then we go on to the standard slide around, if we may move to the next one, please. The liquidity and capital slides where we talk about how we fund the book. Our cost, we talked about, growing low-cost liabilities, which is primarily what we defined as CASA. The CASA account for, 54% of overall deposits, while term deposits account for 45%. The stable funding, we aim to have a customer deposit-led funding approach, right? Our reliance on wholesale funding remains limited. We have very good CASA ratio of 54%, others time deposit of 45%, and that ratio continues to improve. This stands us well in terms of in a good stead in terms of managing the cost of funds. So that's the key call out there, really, in terms of how we fund the book. In terms of liquid assets, we clearly set out here how the liquid asset ratio, as well as the other metrics compare from a liquidity perspective. Last but not least, and the most important, in terms of capitalization, we have set out that we aim to be well capitalized. June, we were at 16.6% total CAR. We finished H1 at 17.5%. In between the two first halves, we raised 300 million of AT1, primarily to repay the existing or the previous AT1, which was issued in 2021 during the pandemic. This was issued at 8%. At that level, a very competitive rate. The new one was issued at 6.625%, issued in November, the third week of November, used to repay the call on the first call date of April 1st. That's why the movement you see, and of course the profit retention and dividend payment. So to sum up, we have a clearly defined strategy as we set out in the slide. The new 3-year program, we are at Prime, which we call the strategy S, is clearly defined. We are executing in the first 6 months. We are pleased with the pace of execution. We are good with our performance in terms of the improvements in profitability year on year, and in terms of our liquidity, capital, and provision coverage, etc. So that's really my summary. A clearly defined strategy, executing well, good set of numbers for the first half. We'll now open for comments and questions, please. Binay had a comment first. Yeah, Bijoy, can we go to Bijoy? Hi, Bijoy. Hope you're well. Please go ahead.
Hi, thank you, gentlemen, for the call. My question is specifically on your cost and ROE. So given ROE of around 8.5 to 8.7%, it's well below the cost of capital, cost of equity, to be precise. So what are the initiatives taken by the management in order to bridge that gap? And how soon we can bridge that gap? That's my first question.
Yeah, Bijoy, where are you from? Sorry, if you can just maybe everyone can.
Yeah, this is Bijoy here. I am from QIC Asset Management.
I'll go. So good question. Yes, return on equity is below cost of capital. That is true for most banks operating here. You see, if you followed our trajectory, then when the CEO and I started, we had a return on 2021. Our return on equity was close to 5%. Steadily, that's improved closer to the 8.9, 8.7. You'd see some more improvements. Over the medium term, we don't issue forward-looking guidance and follow the local stock exchange requirements. Over the medium term, we see our return on equity improving to double digits. And as the sort of in a situation in terms of fiscal prudence, etc., of the macroeconomic indicators improve, then we expect the cost of equity also to hover around the 11% mark. So you should see some improvement in this space over the medium term. The cost income ratio has come down, Bijoy, from 55%, which is what we started, to about 39.1%. We are second best in the industry. We clearly need to manage this prudently because we have a branch network here. Oman is a geographically bigger country relatively, and therefore we don't expect the cost income ratio in terms of to drop to mid or low 30s, etc. That's not prudent. So we are improving our income. We aim to grow. We have delivered over the last 22 quarters, delivered positive jaws, i.e. income growth surpassing expense growth. We will strive towards that in the medium term, probably reach double digits. That's my answer to your question, please.
I'll attempt also at a macro level, Bijoy. Basically, that's the P in our Prime strategy. Profitability is very key. Again, long-term trackers of National Bank of Oman would have seen the last 5.5, 6 years now a very disciplined approach. Any steps, especially say on the M&A or inorganic side, will only be driven by how accretive our that step is for shareholders. The Omani banking sector tends to hover around the 9% ROE approximately, driven really by the largest bank in the country that has a slightly higher ROE than the industry average, but most of the peers are maybe below our performance. So it is slightly a banking sector benchmark level, and we are aiming to exceed that. Like Giri mentioned, we are slowly moving towards the kind of cost of capital level. Definitely, it will not happen in a year or two, but over the planned period is our aim, inshallah. The cost to income ratio is again a focus area. Again, we are disciplined there. Year on year improvement in the cost element, but also we need to continuously maintain adequate investment on, especially on the technology side. There are quite a bit of upgrades that are required, regulatory mandated requirements, plus the business requirements. So we continuously looking at such capex investment, which will maintain our leadership position on the digital side. So in my view, probably we should be looking at around the 41% as kind of a benchmark. If we outperform that by reducing it, then great. But our aim is to ensure that we don't under invest for the future of this organization. I hope we responded to your question.
Yeah, but just to follow up, like given the country's vision of being part of the EM upgrade and upgraded to the EM basket, and the comparison will be with similar EM names, and they have been able to deliver, on an average 12% return on equity. And there are countries which are large in geographical area. They are advancing on digitization, cross-selling, and multiple levers of improving the profitability. So when compared to those peers, the return on equity is quite far, which should be. I mean, I know within Oman you're the second best, but for somebody who has to look at it, and compare, it's still there is a huge gap.
Yeah.
I'm not sure what you can do to bridge that gap, but it can't be, if that's the vision of the country, it can't be just compared to Omani names.
Sure. You're like you said, global investors do have options to look at different geographies, different banks for that matter. Again, my responsibility is limited to National Bank of Oman, benchmarking ourselves to are we very different from the market? I think we are ahead of the market, better than the market. Definitely our aspiration is to move towards the cost of capital levels, but it will take time. We cannot overnight kind of increase and pull a lever to go to a double digit, even if it's low double digit levels of ROE. We are inching, we are moving in the right direction, and we are quite happy in terms of the performance, in terms of net result, in terms of attracting attention, attracting investors. NBO has been quite successful, be it in its different instrument issuance. We talked about the 81, which has been quite widely subscribed for. We had multiple X oversubscription there. On the share price, we've seen a substantial improvement price. Again, when we started our journey, we were around 160, 170 beta. Today we are around the 400 plus something levels. So all in all, with the better matrices, we hope that the performance will continue on the share price to continue to be better.
Thank you. That's it from my side.
Anyone else has any other question?
I think that's a question that came up in the chat box.
Sure. From
Hi, Shrikant. Hi, Shrikant. So from our perspective, yeah, Joyce has got the next question. We'll come to you in a minute, Joyce. So guidance on important line items like, look, our ability to provide forward-looking guidance is limited. We don't necessarily put out forward-looking guidance as set out by the stock exchange here. But, we've said to you that in our strategy, the prime strategy that the CEO talked about, we aim to improve the return on equity, that the Binoy question just now, to double digits. Cost income ratio, not too below this current number. Cost of risk, we are around the 30 basis points number, slightly higher because of prudency that we took in H1, took in some additional provisions. I think, the current numbers are satisfactory, very satisfactory, 30 basis points. And capital ratio, we put out this that, we aim to work around the 16.5% total CAR and CET1 of around the 11% a So that's broadly where we leave this question, please.
I'll just add maybe a few cents. Thank you, Shrikant. Giri had mentioned in one of the slides that the focus has been predominantly on the GRE. This was a key driving business driver for us in the first 4 years of the journey. But slowly we started to also pivot. Number one, the risk profile in the market has become more conducive for us to look at that, more comfortable levels, and it continues to improve year on year. Specifically this year, I think there's quite a high level of comfort, even with the geopolitical situation in the local market. So we've been pivoting away from the GRE. GRE and sovereign tends to be the highest credit rating in any kind of country. So any model might throw maybe slightly higher kind of ECL, plus minus few basis points here and there. So maybe as a result of our change in our approach, as we build a business in the regular side of corporate in particular, you might see slight changes in our cost of credit there, but not to alarming level, because we have a very kind of robust underwriting approach. But this should be more than compensated on improved margin, which is the NII piece that you've alluded to. Clear result of that is also reflective in the first half of 2026. And we believe this should continue. Margins on the non-GRE side tend to be much better than on the GRE side as well. And add to that, the more conducive risk profile in the market.
Shrikant, I hope we've given you some flavor there. Okay, let's go to the next question. Joyce, over to you, please. Good to see you.
Hi, good afternoon, everyone. Thank you very much. Thank you for the presentation. Congratulations on the good set of numbers, and thank you for taking my question. My first question is on your loan book growth. See, this first quarter, we have seen you adding almost around 300 million in loan. And that has been one of the highest that we have seen in the recent times. Could you please explain what are the key drivers that has led to this double-digit growth, and not only for NBO, but for the entire banking sector? We've seen extremely good numbers in terms of asset additions. So what are the key drivers that have resulted in this kind of growth? And how do you see the growth or the asset, the credit market momentum going for the remaining part of the year and for 2027? If you can throw some light on that, that would be much appreciated.
Thank you, Joyce. And again, I'll link it to the responses we gave on the previous few questions. Key aspect for us is that the risk profile in the local market has been improving year on year. And in particular, even if you take into account the blip or the situation when the geopolitical situation erupted, there was a little bit of negativity and worry. Oman continued to be very robust and strong and showed very positive sign. A lot of the planned capex investment continued without any kind of known or major cancellation there. National Bank of Oman took that opportunity, and like I mentioned, we shifted gears maybe late 2024, took team in 25 and 26, where we slowly built or grew more on the non-GRE side, in particular sectors like your power sectors and other sectors, which has shown very positive signs. So we believe that for this year and hopefully even for 2027 to see strong opportunities, good opportunities for lending. How much growth will also depend on the second point that I've emphasized, profitable growth. Again, we need to be focused on ROE and improving the ROE piece. So we are happy to see growth as long as it's shareholder accretive growth. So I want to emphasize this, very important. We will not rush to do something just for the sake of growth. We'll not chase growth for the sake of growth. It has to be a profitable growth for us.
Just if I may please add, thank you. So Joyce, one of the things that you've been following us is the discipline in the pace of execution. As the CEO mentioned, clearly we've gotten the bank to a very good place relative to the market on return on equity, cost income ratio, profitability, etc. But one of the things that we struggle a little bit is see what's happening in the market in terms of pricing of loans or deposits. What differentiates us, certainly internally, we are very disciplined, right? We're not going to chase something because some other bank is doing it to grab market share. This is an ongoing scene here in the banking industry, and what will differentiate us, we believe in the long run, is being very disciplined with the growth. Hopefully we've given you a flavor. Please shoot if you any follow-up question. Thank you.
Sure, that's very clear. Thank you very much. Next one that I have is on the new two regulatory developments that has happened. CBO has announced that the Islamic banking windows of conventional banks should be separated and run as an independent entity. Even though CBO doesn't have, is yet to clarify on the timelines. I just wanted to pick your brain on, what are your thoughts on this one? The second regulatory change that we have seen is from the FSA, which said banks cannot run the investment banking operations as part of their core banking activities, and it has to be done through an independent entity. So how do you see these two regulations panning out, especially when FSA has put a timeline of 3 years for you to separate the investment banking entities? So how do you see this panning out, and what kind of potential impact on the operations and the financial performance of banks do you see coming up over the next 3 to 5 years?
Sure. Thank you very much. A very important question. So I'll attempt at the macro and then maybe slightly drill into National Bank of Oman in particular. So for the benefit of everyone else, there've been a slew of new regulatory changes that has happened in the first half of this year. In particular, what came towards the end of Q2, was number one, the need for separation of Islamic. And these entities will also, at a point of time, will have to also be listed on the stock exchange as well. So banks can own for a temporary period of time 100%, but then we'll have to sell a portion of that. And also FSA issued regulatory framework for separation of investment banking activities. Both of these businesses are very key for banking sector, contributed very positively. Some of the activities, in particular asset management or wealth management, where in wealth management we do sell funds and other investment products for the premier segment of our retail business, particularly the high net worth individuals. So they are a large contributor to banks' fee income side as well. For the Islamic banking, I think there's strong opportunities that are there. We've seen substantial growth that has been there, especially in the last few years, with few corporates and in particular GREs preferring Islamic structures than conventional side. And we've seen the total Islamic banking asset reaching 20% of the total banking sector in Oman. I think one of the highest in a very short span of time in the globe. So I'm personally, I feel there are a lot of ample opportunities there for Islamic banking going forward. Again, the question for NBO is definitely what is the best for shareholders. We've been in discussions with our board. We updated the board in the last board meeting. We are yet to go back with kind of a certain recommendation. As per the regulation that was issued, banks will have to respond to the Central Bank of Oman before 31st of December with their preferred option, with justification approved by the board. So we are in the process of doing an in-depth analysis. Again, Muzan has contributed very positively to National Bank of Oman. We have positive view about the sector. Key aspect for us is ensuring that the return and its accretive to shareholders will continue to be there. On the investment banking side, although FSA did issue, we hear that central bank might come up also with certain kind of regulation that will be applicable to banks. So we are waiting for clarification on that front as well. We are governed by both regulators and will aim to comply with the regulation of both. But we also need to wait to see what the central bank will also issue. In terms of what would happen, I think we can see potentially slew of potential M&A in the market on that front. We've seen initial actions, but probably there could be some more.
George, I hope we gave you a little bit of color there.
Yes. Thank you very much. That's it
Thank
from
you.
my side. Thank you.
Thank you.
Wish you all the best.
Thank you. There's a question in the chat box from, can you just go to that question, please? Mohammed, is it? So thank you for your presentation. Impairment charges increased faster than loan growth. What were the main reasons behind the increase? Should we expect a similar? So let's just go through this. If you please look at our detailed financials which were published. The loan growth that on a gross basis, gross I'm talking about, is 9.3%. The impairment, then you see net impairment is up 38.2%. But if you just look at the split, then you'll see that gross impairments is up 14.2% and recoveries are up down 20.6%, please. That's not in these financials. It's in the, I'm talking about retail published financials which have been published on MSX. They're available on MSX and our own website. So it's not necessarily nothing alarming there in terms of, oh, loan growth grew this much and impairment is growth. No, not necessarily. One, as we say, our commitment on impairment is that we will be prudent. given the macroeconomic developments in the region, we wanted to be a tad more conservative than usual on impairment. That's the reason why we front-loaded some of our impairment charges into the first half. You know very well what's happening in the region, so we wanted to be prudent and front-load some of the charges, number one. Number two, year on year, the recovery book is loan recovery is something that we are very focused on because that helps all of us. But as we said, there are no new additions to our recovery portfolio in the last 5 years, no new debt. So we are talking about recovering a fairly old book, historic, legacy, whatever. For those of us who've been with us, the CEO and I do not use the word legacy. We take responsibility for what is there, and we try to solve for that. The historic book, then there's only so much you can potentially recover. It's slow as well, given the legal system. Not that we can't recover, but the pace is slower. So that's why the recovery number itself was lower year on year. That is why you see that big increase. Nothing alarming at all. Full year, again, we don't necessarily publish out guidance, but all I would say is we will continue to be prudent in terms of our provisioning in case the CEO wants to add.
It's a question of coverage, of how much NPL coverage. If you look at the slide 15, slide 15, yeah. You can see the purple box in the middle, NPL coverage, have improved from about 91.7 to 97%. It's just prudency and building cushion. We're concerned a bit on certain sector, in particular hospitality, that got impacted. February, March, and April tend to be part of season for the sector, and as you'd appreciate, the disruption in travel, etc., happened during that period of time. Has anything panned out until now? Alhamdulillah, touch wood, nothing has panned out. But again, prudency that we mentioned, that driven our increased provisioning numbers.
Any other questions?
Is one new?
Mohammed is saying, just come down.
There's another one.
Mohammed's got a question. If you want to pick that.
But on the loan grade, given neutral position in the region. Nisha.
Mohammed's question was a liquidity provider. Attract more institutions.
Considering appointing a liquidity or taking other steps into
You do that.
Yeah. Yes, it's part of our kind of review. We had reviewed it 2 years ago, I think, or at the start of when MSX launched this initiative. We felt that let's wait and see the experience of others before we take that step. Again, we'll not pause or not stop at anything that will help shareholders as well. So we are planning to explore this again, and if we deem it as positive for shareholders, we will undertake it.
Yeah, we can go back to text box. Yeah.
Can you please elaborate a bit more details on the loan growth given Oman neutral in region development and the potential impact on them, both nominal and risk-adjusted, from changing loan mix to non-GRE? So again, if you look at the different kind of initiatives or projects in the country, that continues to be as planned, and we believe that it's building up steam as well. So we are quite positive in terms of the loan growth or the opportunities available for us to grow in 2026 and 2027, definitely. How will Oman benefit from its neutral or its position? there's maybe a lot of factors that might come into play there that are beyond our kind of skill sets or ability to anticipate. But again, overall, we believe that it will only be positive for the country, and it will be potentially a net addition over and above the opportunities that we are aware of. One example is, for example, 2 weeks ago, the government announced about 4 billion Omani Riyal of project in Salalah, for example, new infrastructure, transportation, etc. 4 billion is approximately more than $10 billion over a few years. There's a lot of projects in terms of redevelopment of the city of Musqat, the public transportation system in the country, the water system in the country as well. All these are projects that are seems to be coming online as planned. So in itself, even if you remove the implication and impacts of the geopolitical situation, we believe that Oman has ample opportunities for us to look at and build a very strong and robust loan book there. Anything that comes from Oman's position, given the geopolitical, will just be a net addition and net positive for that.
So I hope we've answered your question, please, Misha.
Any other questions? Okay, then, if there are no further questions, we would like to thank you all for joining us today, and we truly appreciate your participation. And inshallah, we hope to see you in the upcoming sessions.
Thank you, everyone. Really appreciate your patience and taking the time. And thank you very much for this interesting and robust questions. We are always available for any further queries that you might have, and happy to tackle it even one-to-one, inshallah. Thank you very much, Faisal.
Thank you. Shukran, Jazil.